Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending March 17th, 2023. Looking at the market indexes for the week, the TSX, Dow Jones, and Russell 2000 were all down on increased fears of contagion in the US smaller banks. The S&P 500 and Nasdaq, however, were up as technology did quite well this week. Oil was down as well, and gold was up significantly on those same fears. There's a theme of oversold energy with people taking profits and piling into technology. That's what's happened this week. Looking at Canada first, the lower oil prices have significantly and negatively affected the prices of Canadian energy. The US bank failures are expected to make people afraid and slow spending, thereby needing less energy, and oil sold off this week, causing Canadian energy stocks to come down as well. Turning to the US, the big news out of the US is the failed banks. To bring you up to date, there was the Silicon Valley Bank, which was first, and it had some bad investments. And private equity and technology startups all communicated together and said that they need to get out and take their money out. They're insured for 250,000 by the Federal Deposit Insurance Corporation, or FDIC. The federal regulators stepped in on the March 11th weekend to cover customers of Silicon Valley Bank who were at risk of losing their money because of the $250,000 cap on guaranteed deposits. The plan called for FDIC insurance to cover depositors and won't rely on bailouts or taxpayer dollars, according to officials. The Treasury Department, Federal Reserve, and the FDIC issued a joint statement saying they were, quote, taking decisive action to protect the U.S. economy by strengthening public confidence in our banking system, end quote. Authorities had worried that contagion in the banking industry would occur if the SVB fallout couldn't be contained. And then there was the Silvergate crypto friendly bank, which will, quote, voluntarily liquidate, end quote, its assets and wind down operations. Silvergate's demise was the result of a straightforward bet on cryptocurrencies, particularly large deposits and other business from crypto exchanges. FTX was one of the bank's largest customers. Silicon Valley Bank didn't bet heavy on crypto, but it mostly served tech startups in the region. Signature Bank was another bank which the regulators closed in New York on the 12th. The bank's connection with crypto seemed to have spooked depositors after Silicon Valley collapsed, prompting a run on the bank's deposits, which in turn prompted action from the regulators. The Fed announced that Silicon Valley Bank and Signature Bank depositors, insured and uninsured, will be made whole by the Federal Deposit Insurance Corporation, but without using taxpayer money. Investors will not be. They lose their stock investment. It also seemed as if the US regulators have indirectly said they will cover deposits at all banks across the board to reassure the public. They should come out and say it officially to make everyone feel a lot better. There was a group of 11 financial institutions that offered regional bank First Republic, among the worst hit by the cascading fallout from the recent bank failures, a lifeboat in the form of 30 billion in deposits to shore up its holdings. Bank of America, Wells Fargo, Citigroup, and JP Morgan Chase will kick in about 5 billion each, while Goldman Sachs and Morgan Stanley will deposit around 2.5 billion. The Justice Department and the Securities and Exchange Commission, SEC, are investigating the meltdown of Silicon Valley Bank. That should come as no surprise given that it was the biggest bank collapse since 2008 financial crisis. While the probes are still in their early stages, federal investigators are looking into stock sales that SVB executives made ahead of the tech-friendly bank's failure. CEO Greg Becker and other executives cashed out a total of $84 million in stock over the past 2 years. Critics also took aim at the bank's leaders for taking bonuses just before regulators closed it down. Keep in mind that the US has about 13,000 banks, and they aren't as well as capitalized as Canada's. US banks fail pretty frequently, while the last Canadian failure was on June 4th, 1996, when about 2,600 Canadians discovered that their savings were not immediately available from their small financial institution. They had entrusted a total of $42 million in deposits to a Calgary-based security home mortgage corporation, which had closed its doors for good at that time. Keep in mind that no bank has all of its depositors' money in its accounts. The money is getting loaned out or it is getting invested to allow the bank to make more money. So it's on faith that the bank is fine. If people feel things are going wrong and all decide to pull money out all at the same time, the bank is going to be insolvent very, very quickly. Now, contagion is when other banks own investments in the failed bank and they get into trouble in churn. Banks can also stop lending to each other or to higher risk clients since they are afraid they won't get their money back, which slows down the money and credit flow when banks feel they are under threat. This slows down the economy and is deflationary. There is no reason to expect contagion with other institutions other than having crypto as a common denominator for two of those banks. There is definitely no reason to suspect Canadian banks, but they still sold off because of the fear and not on fundamentals, which didn't change. There are experts saying that the interest rate hikes are indirectly responsible for the bank issues. Rate hikes usually happen until, quote, something breaks, end quote, and it is theoretically the banks. I am not convinced this is the case, especially since two of the banks were crypto related. The SVB closing its doors was due to the investments they made, which lost value due to the higher interest rates, but regular investors lost money in bonds as well with higher rates, so that's a tenuous connection. I also don't expect the bank failures to stop the US central bank from raising interest rates, since they are targeting inflation, which wouldn't change because of this necessarily. Do note that the bank failures are disinflationary because they make people feel less confident and therefore people spend less, lowering demand and prices. Turning away from the bank failures, on Tuesday, the US had its consumer price index read for February. It was mixed, with most of the figures being around the forecast and better than a month ago, if only a little lower. The bad news was the core CPI month over month, which was higher than the previous month and than expected, but wages and salary actually came down for the month, and it was significantly lower than the previous months, which was great news. With the bank issues in the US, 0.5% rate hike next week in the US seems far less likely, but a 0.25% hike is expected once again with the relatively bad CPI numbers. The US initial jobless claims came in this past week lighter than expected, 192,000 instead of 205,000. So that's good news for the economy, but bad for increasing interest rates some more. Now for some bits and pieces. The Swiss bank Credit Suisse, which has been weak for years and is in a downward cycle of stubborn costs and weak revenue, was finally in financial trouble as the fourth bank in the last 2 weeks. The Swiss central bank and the government stepped in with financial aid quickly, giving Credit Suisse access to borrow up to $54 billion. Finally, looking at next week, we have companies reporting. On Tuesday, it is Nike, GameStop, and the Canadian company Boyd Group. On Wednesday is Tencent. Thursday, we have the consulting Accenture, General Mills, and Carnival for a travel read. Economic events next week. On Tuesday, we get the Canadian Consumer Price Index, so we'll see how our inflation is doing. And we get US oil inventories, which affect oil prices. On Wednesday afternoon is the big US interest rate decision with a 0.25% hike expected. On Thursday, we have US continuing jobless claims. That concludes my thoughts for the week. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.